All right, so good afternoon, everyone. Welcome to today's session, and thanks for taking time out of your busy schedules to join us. My name's Angela Bilski, and I'm a municipal training advisor with Alberta Municipal Affairs. You probably have seen me on other webinars. My role is to support municipalities in understanding and applying property assessment and tax legislation and processes effectively. I've been with the ministry now for almost 10 years. And prior to that, I worked in a couple of small roles in various legislative roles. Still on a bit of a learning curve after all these years, especially with tax and assessment, but thankfully it's a bit of a flatter curve now than when I first started with the ministry. Helping out with technical logistics and questions, I have with me my esteemed colleague, Lucien Cloutier, as well as our esteemed manager, Desiree Corey. So just a little overview of what we're going to cover today. This is the first session of the 2-day workshop we have planned. This used to be a full day in-person workshop, but we thought since it's virtual, we'd split it up into 2 afternoons, make it a little bit more palatable for folks. So in this first session today, we'll start with the legislative framework for assessment and taxation. And that's the foundation for everything we do in property assessment and taxation. So we'll take a look at the key pieces that govern property assessment, taxation, and tax recovery in Alberta. Okay, copy of the presentation. I have a link if I think that was sent out, but I will put that in the chat where you can access the materials and the slides on my Google Drive. Hopefully that's successful for folks. There should have been an attachment to the email that was sent, but if you didn't get that, there's the materials for you there. All right, so understanding these rules is critical because they set the boundaries for municipal authority and ensure fairness and consistency. Then we'll move into the property tax cycle and timelines. So this section will give you a clearer picture of how the process flows from start to finish. And we'll begin with property assessment basics, what assessments are, who is responsible for them, and why they matter. And then we'll look at the second segment, which is the taxation process, including how tax rates are set and applied to assessed values. And then finally, today we'll cover collection strategies. And those are some practical approaches municipalities can use to ensure timely payment and minimize arrears. And then I've got a few questions, I guess, or key points to wrap it up at the end and to share some further resources with you for looking into on your own time, if you'd like. We do have 3 hours scheduled for this session, so it might be necessary to take a bit of a break halfway through after we get through the assessment piece. And like I said, when we did this session in person, typically we'd have so much discussion and questions, we would kind of be rushing to get through all the content. But with this platform, it might be a little bit different. So this is a bit of a, we'll see how it goes in terms of time. And what we've enabled with this session is a Q&A. So if you do have any questions as we go, please put them in there. We'll try to manage them. We have Des and Lucien helping out with managing those questions, and we'll try to answer them in real time. But if that's not possible, if we get inundated with questions, we might have to put them in written form and get back to people. So, but yeah, if anything's unclear or needs further explanation, please put those questions in the chat and we'll see what we can do with those. So let's get started with the first section, which is the legislative framework. So this is an outline of the legislative framework that governs property assessment and taxation in Alberta, and it's important to understand how these different layers work together. So at the top, of course, we have the Municipal Government Act, or MGA for short, and this is our primary legislation in Alberta for the governing the operation and administration of municipalities. So we often refer to the MGA as enabling legislation that grants municipalities the powers, responsibilities, and general parameters that allow them to do a number of things, such as creating bylaws, delivering services, and managing local affairs in ways that fit their unique communities. So this flexibility is intentional. It recognizes that local governments are best positioned to respond to local needs while still operating within provincial oversight. Because you're probably all aware there are no two municipalities that are exactly alike. And the MGA tries to accommodate differences like population, demographics, location, those types of things. And when it comes to assessment and taxation, there's two key parts to focus on. So part 9 is the property assessment part, and then part 10 covers property taxation. So these sections set the foundation for how properties are valued and how taxes are levied. Then we move on to the next level, which are regulations. Regulations provide more detailed rules and processes under the MGA. And two important regulations you've probably heard about are COPTR, which is the Community Organization Property Tax Exemption Regulation, and the MRAT, which is matters relating to assessment and taxation. So the COPTR explains how certain organizations like nonprofits may qualify for tax exemptions, and the MRAT provides specifics on assessment procedures and standards. So that ensures consistency across municipalities. There are also probably a couple more regulations in these areas, the assessment complaints one, for example. And then finally, at the lower local level, or the lower level, is the municipal bylaws piece. So bylaws are created by each municipality within the framework of the MGA. Some are mandatory. For example, every municipality must pass a property tax bylaw annually to set the tax rates for the different property classes. Others are not mandatory. Discretionary is how we consider those, but likely for a municipality to have bylaws to impose penalties for late payment, for example. Some might have local improvement levies or community aggregate payment levies. And still others may have tax installment payment bylaws, or maybe you have all of those. So while the MGA and regulations provide the structure, bylaws apply that structure locally. So the key takeaway here is that the system works in hierarchical layers. Provincial legislation sets the foundation, regulations add detail, and municipal bylaws implement it at the local level. And as in any hierarchy, lower levels cannot override higher levels. So you can't have a bylaw that is contrary to the MGA or says something different than the MGA, for example, or regulation. All right, so that's the legislation piece. So this nicely colored circle or cycle is what we'll focus on today. So that's the annual property tax cycle, starting with assessment / property valuation, budget approval, assessment roll and notice requirements, applying tax rates, talking about some collection options, with this cycle repeating itself annually for the most part. However, when there are collection issues and folks go into arrears, then we have an additional process that overlays the typical annual cycle, that being the tax recovery process, which is on tomorrow's agenda. So I kind of think of it as maybe more of a 3D type of cycle. We have the regular cycle at the below, and then we have the tax recovery cycle that goes over top of that, and they kind of still cycle not together, but independently, but it's overlaid on one on top of the other. So hopefully that makes sense. That's how it's set out in my head. All right, so we're going to start off with property assessment. So the assessment of the majority of properties in Alberta is based on market value. So you might have heard the term ad valorem, which means according to value. So property taxes are based on the value of property. What that means is that the value assigned to a property is what it would most likely sell for on the open market. Both taxes and assessments are financially based on a calendar year, starting January 1 through December 31. However, the valuation date for property is July 1st of the previous year. So what will be taxed in 2026 is actually based on the snapshot of assessment values as of July 1st of 2025. Market value is the price a property might reasonably be expected to sell for if sold by a willing seller to a willing buyer for appropriate time and exposure in an open market. And there are 3 different approaches to determine market value, which I'm not going to really get into, but they are sales comparison, income, and cost. But for our purposes today, assessors use one or more of those approaches to arrive at a property's assessed value. So key characteristics of market value are number of things. The most probable price, not the highest, lowest, or average price. Market value is expressed in terms of a dollar value. No more or no Bitcoin yet or anything like that. It assumes a transaction between unrelated parties in the open market. It also assumes a willing buyer and a willing seller with no advantage being taken by either party. And it recognizes the present use and potential use of the property. So the market value standard is considered the most fair and equitable means of assessing property. It's fair because similar properties are assessed in the same manner, and it's equitable because owners of similar properties in a similar properties in a municipality will pay a similar amount of property tax. That's what I was trying to say. There's a few other types of assessment listed here other than market value. So with respect to regulated assessment, some types of properties are difficult to assess using a market value assessment standard for a number of reasons. For example, they seldom trade in the marketplace, and when they do trade, the sale price usually includes non-assessable items that are difficult to separate from the sale price. Sometimes properties can cross municipalities and municipal boundaries. And finally, properties are all unique in nature. So the regulated standard uses rates and procedures prescribed by municipal affairs to calculate assessed values for certain types of properties. So these types include farmland, machinery and equipment, and designated industrial property, including linear property, railway, and major industrial plants. A note about farmland, it's assessed on the basis of its productive value. So that is the ability of the land to produce income from the growing of crops and or the raising of livestock. The productive value of farmland is determined using a process that sets a value for the best soils and then makes adjustments for less than optimum conditions, such as stones or rocks, the presence of sloughs or topography. Farmland is assessed by local assessors. All right, and then we get just a note about equalized assessment. So that's an annual calculation that creates a common assessment base for distributing the provincial education property tax requisition, the regional requisitions of seniors housing authorities, and the cost for police services under the provincial police service agreement among municipalities. So this may also be used to distribute the provincial and federal grants that municipalities sometimes receive. So the calculation for equalized assessment removes the variations in assessment levels to make the assessment basis more comparable among municipalities. And so total taxable assessment in each municipality is adjusted to common market value. So in other words, it levels the playing field for municipalities so that property tax requisitions and grants can be fairly allocated. How is equalized assessment calculated? I'm not going to get into a bunch of detail about that because that's not my area, but to summarize, each year, local assessors collect information on properties that have sold including sale prices, and submit it to the province. Then we have the folks in the assessment services branch of our ministry audit the information and analyze the differences between the assessment values of sold property and their actual sale prices. This analysis results in an overall assessment level for each assessment class in the municipality. And in accordance with legislation, assessment levels must fall within a range of 95 to 105% of market value. Also, equalized assessments have a 1-year time lag when compared to municipal assessments. So when there are major swings in real estate, like we've seen lately, it takes a few years to see the effects of those swings in assessment on the school tax. And then finally, the designated industrial property assessment, or the DIP for short. That's the assessment that's prepared by the ministry. Some of it is regulated and some market value. So for the longest time, the province prepared linear assessment for municipalities, but in the last couple of years, they've expanded that role to now include linear property, but also railway and specific major plants. So they have a little bit bigger purview than they used to have, just over linear. And the definition of designated industrial properties can be found in Section 284 of the MGA. After the assessed value of a property has been determined, the property is assigned an assessment class, and that's a pretty important part of the assessment and taxation process. So let's look at the different assessment classes provided for in the legislation. I see there's a question about farmland. I believe it's based on 1970 something value, productive value, and I don't believe that has been updated, but maybe one of my colleagues has more information on that, but thanks for that question. Right, so property classes and subclasses. Currently, there are 4 broad classes of property assessment provided for in the MGA. And these are important because the assessment class determines the tax rate that will be applied to each property, as assessment classes and subclasses can have different tax rates. And that's Section 354 that provides that. So starting with Class 1, which is residential. Residential can be subclassed by bylaw to any extent that council considers appropriate. And this is set out in Section 297, Sub 1. So some common examples of subclassing for residential are vacant or improved, or you could put multifamily versus single family. So there's a number of different subclasses you can create. A lot of rural municipalities have subclasses for country residential and hamlets. So there's all kinds of different subclasses that municipalities out there use, and again, based on their unique circumstances. So the question is, why might a municipality want to create different subclasses? So because they can charge different rates for different subclasses, they might want to incentivize certain behaviors. For example, a bit of a hot topic lately is some resort communities and large cities that are experiencing a housing crisis are looking at setting much higher tax rate for vacation and short-term rental properties to incentivize their owners to either live in them full-time or rent them out to someone who will. So we see a few municipalities that are kind of looking at that subclass to perhaps address the housing crisis they have in the municipality. So secondly is Class 2, which is non-residential, and that's made up of designated industrial property and linear and commercial properties. And non-residential can now be subclassed into vacant, small business, and other residential. And that used to be set out in a regulation, but those rules have been put right into the MGA in Section 297, Sub 2.1. Class 3 is farmland and Class 4 is machinery and equipment. And currently, these last two cannot be subclassed any further. Something to note when it comes to this is one or more classes or subclasses may be assigned to a property. So for example, a commercial building could have a residential component as the living quarters. All right. So the next piece in the cycle is the start of the tax year and budget approval. So taxes are considered imposed on January 1st of each year. For the interpretations of some of the specific sections relating to assessment and taxation, Section 284 of the MGA specifically addresses the definition of year, meaning a 12-month period beginning January 1 and ending on the next January 31st. Also, the definition of a taxpayer is shown under the general interpretations in Section 1. So that is the person liable to pay a tax. To follow the chronological nature of this presentation, another important function is required at this stage, and this involves the requirement for council to approve the operating and capital budgets by January 1st. So the annual budget is an absolutely critical step, which determines which services will be provided to residents and at what levels, and ultimately determines the tax rates necessary to fund those services. Although the operating and capital budgets are required to be passed before January 1 of the current year, often an interim budget is passed at that time, with the final budget approved by council early in the year after they have been given more information on assessment numbers and provincial grant funding levels. So it just depends on the municipality, on their circumstances, if they are able to pass the final budget by the end of the prior year. And some feel it's better to wait and do an interim and then pass a final one when they have more information. So once the assessments have been completed and the property classed, then the assessment roll must be prepared by February 28th, and that's set out in Section 302. How do you know who the assessed person is? Much of the time it's the owner of the property, but that's not always the case, and I'll talk a bit more about that in a second. But before an assessor can subclass the residential and non-residential classes, council must have a bylaw in place. So since the assessment roll must be prepared by February 28th, this bylaw should be passed well before that. If the subclasses need to be changed for the next taxation year, that bylaw should have been already taken to council, unless that's something you're still going to be doing in the next day or two. It's not that you have to do a bylaw every year. It's only if you're going to be changing it that you have to make sure it's done by February 28th. Section 310 of the MGA requires a municipality to send out assessment notices no later than July 1st. That doesn't include the assessment notice for the DIP properties, as those are currently done by the province. And I'll provide a bit more details about notices in a minute. So once the assessments have been completed and property has been classed and subclassed, the assessment roll is prepared by February 28th. And Section 303 outlines what information must be included on the tax roll, or sorry, the assessment roll. So obviously the legal description and the name and mailing address of the assessed person. Again, how do you know who the assessed person is? And like I said, usually it's the property owner, but there are other situations where that's not the case. And again, I'll explain that in a little bit. Is the property a parcel of land, improvement, or both? So improvement means a structure, a designated manufactured home, linear property and machinery and equipment. There's a definition that's defined in the MGA. Obviously, the assessment value and the class or classes needs to be shown on the roll. The school declarations have is the property fully or partially tax exempt. And a bit of the newer requirements here, the taxes deferred under sections 364.1 or 364.2. So those have been passed in the last few years. And that deals with the brownfield tax incentives and incentives for non-res property. I'll mention that later in the collection piece. And then any other information considered appropriate. There's also a provincial assessment roll, and the information required on that roll is virtually the same as this assessment roll, the municipal one. However, this document is specifically for DIP properties, and it's the province's responsibility to maintain that roll. So a few other important sections to touch on. So Section 304 is kind of a critical section as it outlines a number of criteria to determine how to record the assessed person of a property. So for a parcel of land, the section says the owner is the assessed person, but for linear property such as a pipeline, the operator of the pipeline would be the assessed person, not the landowner. Also, it talks about leaseholders and leases and things like that. There's a long list in 304 of different properties. Designated manufactured homes or DMHs. In this section, it says the owner of the DMH is the assessed person unless the municipality has passed a bylaw making the park owner the assessed person. So it's important to know who that assessed person is because Section 331 specifies who is liable to pay, the assessed person is liable to pay the taxes. So you have to know who that person is. Additionally, Section 304, subsection 3 provides that if a person purchases a property or becomes liable to pay the taxes, they are required to notify the municipality of their mailing address. And that seems to be a common issue that we hear about when people don't get their tax notices on time, and then they try to blame the municipality for not getting, not sending them that notice when the municipality didn't have their new address. Another important section is 305, which is correction of the roll. So this provides your assessor with the ability to make changes to the assessment even after the roll and notices have been prepared and sent. And another fun one is section 307, which is the inspection of the roll. So 307 says any person can come in and inspect the roll during office hours. So this is a bit of an override of the privacy, used to be the FOIPAC, now the ATIA. And this often creates some discussion, but persons are entitled to view all the information that must be included on the roll, including names and addresses. So from our perspective and from the legislation, it cannot be redacted. So I know a lot of places like to take out the names and such and addresses, but Section 307 says otherwise. So to kind of maybe minimize how people can find information on the assessment roll, we would suggest that it's printed off in order of the roll numbers or legal descriptions so that people coming in to inspect it can't easily search by owners' names. It's a little bit of a best practice there. All right. Don't see a lot of questions coming forward unless I'm in the Q&A. There are, but we will take a look at questions after I get to the end of the assessment part. So in terms of notices, there's a couple of options. for municipalities with respect to sending them out. So some send a separate assessment notice from the tax notice, and some send a combined notice. So this will depend on what works better in your specific circumstances. So a lot of the bigger cities, they've probably sent their notices, assessment notices out already, and then the tax notices follow later on in the year. But regardless, the requirement still stands for what the assessment notice must show in accordance with the legislation. So section 309 lists what the assessment notice must show. A bit of a newish provision is section 308.1, notice of assessment date. And that's the requirement for an assessor to annually set a notice of assessment date, which must be no earlier than January 1 and no later than July 1st. So just going to point you out, you're going to want to refer to a helpful schedule put out by the Assessment Services Branch area each year, which shows the relationship between the dates for mailing, the assessment notice date, and the deadline for complaints. So typically, it's not a good idea to set the notice of assessment date on a weekend or a holiday. And if you need to send an amended assessment notice, it can be sent no later than the date of the tax notices, the date the tax notices are required to be sent. The notice may also include several assessed properties if the same person is the assessed person for all of them. And if an assessed person wants to file a complaint about their assessment, they still are obligated to pay their taxes in the meantime. All right, so hopefully that is fairly straightforward. So just a few more notes about assessment notices. It must be sent at least 7 days prior to the notice of assessment date, which that date is set by the assessor. And a designated officer must certify the date on which the assessment notice is sent. And in section 310, it's is that 7 days, and it's referred to as clear days. So what is meant by clear days is the days on which both the events occur are to be excluded. So for example, if the notice of assessment date is January 11th, the notices must be sent by January 3rd. Also, a newer provision is section 608.1. So council may pass a bylaw allowing for the use of electronic means to send documents, including your tax and assessment notices. And in order to send documents electronically, there must be an authorization from the recipient that they are okay with receiving documents this way. So their consent has to be provided. Section 311 is the publication of notice. It's not a new requirement, but I think there was a bit of an amendment to add the piece about the designated industrial property assessment notices, that they have to be published in the Gazette. So nothing major there in terms of for municipalities. All right, so that's what I had for the assessment portion. Do we have any questions in the Q&A that were put in there? No? Oh, we do have.
There was one question, Angela, which is a good one regarding if you have your assessment available on your website, do you need to redact the names? Is that just a best practice, or what does the legislation actually require? Section 303 says the name is part of is part of the roll, and Section 307 says somebody can inspect the roll, but this is what's being uploaded to the website. Is that make it different at all?
Yeah, so the act is silent on uploading it to the website or or providing any other means of people being able to look it up. And I know the cities do that for sure. But yeah, if people want to come into the office physically and look at the roll, then nothing is redacted off that version in the office. But yeah, posting them on the website, I believe, there would be no personal information like names or anything like that or addresses. Des, do you have anything to add to that?
Hi, yeah, I'm just looking for an old Q&A we had on this. But my spidey senses would say for sure you're not going to print it in name order, right? Like you're not going to show it in name order. And if I'm putting it online, I probably would pull the name. That would be what I would suggest. But if it's them coming to look at it in the office, like you said, Angela, for sure,
Mhm.
they need to not redact anything.
Yeah, and I always used to refer to a very old ancient Q&A or FAQ from Service Alberta with regards to FOIP, and it's really badly outdated. I don't even know if you can access it anymore, but it was pretty clear that you can't redact anything on the version that people can inspect in the office. And I know a lot of people are uncomfortable with that I've talked to over the years. But yeah, that's what the legislation. And maybe it's worth looking at for future amendments to the MGA perhaps. To maybe look at that to see if it still makes sense. But so displaying anything on your website would be up to like your policy that you've established for that. You would establish your own kind of rules in your policy about anything above and beyond what 307 requires. I'm just going to go back into the chat here. I see there's a bunch of activity. So yeah, we've been told that we cannot give ownership names of a role to the public. Are you saying that you can provide the assessment info to an interested party with the owner's name on it in the office? That's what section 307 requires. Anything else that we see that we'd like to address? There's a question about school declarations. I don't know if we're going to be able to, we might have to get back to you on this. Any mechanism available to municipalities to effectively cap or smooth out the tax bill impact of significant assessment increases on some properties? Okay, and Lucian said that there can be different residential subclasses with different rates. Hopefully that answered that question. Okay, we might need to get back to people on the school declaration piece. So there's another comment about section 307. So I did point out the section that lists what's must be included on the assessment roll, which is the names and mailing addresses. So that's what we go by for section 307. I know it's kind of, people find it cognitively dissonant to hear that. I get it. Um, and I guess people can get legal advice if they. I know we've often gotten calls from people coming into an office and they're refused to see the whole assessment roll, and they end up calling us on the spot. So it depends if people are familiar with the legislation and what they believe they can have access to. So we'll start with the taxation segment of the cycle. And again, taxes are considered imposed on January 1st each year. And like I had mentioned a bit earlier, year is defined as the 12-month period beginning on January 1 and ending on December 31st. And again, taxpayers defined as the person liable to pay a tax. And that ties to the assessed person. All right, so to summarize, assessment is the process of estimating a dollar value on a property for taxation purposes, which is used to calculate the amount of taxes that will be charged to the assessed person. And when it comes to taxation, it's the process of applying a tax rate to a property's assessed value to determine the taxes payable by the person responsible for paying them. After assessing the value of each property, the next step is to apply a tax rate to each class of properties to generate revenue to fund the delivery of public services. So people often think of property taxes as a fee for service, which is not totally the case. They're more so a method of distributing the cost for government services across properties based on their respective value as an indicator of wealth and ability to pay. So you'll hear people complain about that all the time, that they pay taxes and they don't get anything for it because they don't use the services, but just a bit of a mindset switch, I guess. So now let's take a look at more detail on property taxation. And like I had mentioned, that's part 10 of the MGA. But first, let's look how the tax rate is calculated. So it's a overly simplistic formula, I guess, at this point. It's calculated by dividing the budget requirement by the total assessment. So I have a nice simple example on the slide here. So this municipality requires $2 million to cover their operating and capital costs after considering other revenue sources such as grants and user fees. So just their budget amount, not including those other sources of revenue. And if their total assessment is $220 million, they need to apply a tax rate of 0.0091. And some people are more familiar with the term mill rate, which is calculated by multiplying the tax rate by 1,000. So in this example, the mill rate would be 9.1. Before tax rates can be calculated and applied, council has to approve the operating and capital budgets required for the upcoming year. Again, your council may have passed their final budget late in 2025, or they might have passed an interim budget late in the year, and they'll be passing a final one in the next few months before the tax rate bylaw is passed. So the question is, which part of this equation is the part that council has control over? And the answer to that is their budget requirement. So that means administration must ensure council is aware of the effects of the proposed budget on tax rates when they are having their budget discussions. So that's the appropriate time for discussion on revenue requirements and the resulting tax rate, not when passing that tax rate bylaw. So when they're determining budget, you want to give them examples and scenarios during their deliberations to reduce that sticker shock when they get the draft tax rate bylaw put in front of them. So it's a good idea to present them with example tax rolls, tax rates, and resulting tax bills. There should be limited discussion, like I said, when it comes time to pass the actual tax rate bylaw, as the bylaw is simply a result of the decision on the revenue in the approved budget and this calculation. So if your council decides the tax rate resulting from the approved budget is way too high, then the budget must be revised to reduce the expenditures so that the revenue requirements are lowered enough to produce a tax rate council can live with. And if council wants those budget reductions made, they are the ones that must specify what programs or services will be reduced and not simply ask administration to cut a certain dollar amount or percentage, because council has the legislative responsibility for setting the budget, not the administrative folks. Okay, hopefully that's straightforward. And this is just an expansion on the simple formula to show distribution of the burden of the tax over residential and non-residential classes. So in order to calculate the tax rates for each class, the municipality needs to determine what portion of the $2 million tax requirement will be collected from each assessment class. So like I said, residential versus non-residential. So if the municipality makes a policy decision of 75-25 split between res and non-res, then they will want to collect 1.5 million from residential and then $500,000 from non-residential. So then the resulting tax rates for each of those will be 8.3 and 12.5. So that's just showing distribution. It obviously things can get subclassed further, which makes it a little bit more complicated, but that's just a bit of an expansion on that example. And this slide, I apologize, I added this morning. I just wanted to make you aware that there are some restrictions on tax rates, and we do talk about this a bit more in our tax rate bylaw webinar. I know there's an older one still on our YouTube channel, but this just shows kind of the restrictions there are in the legislation. And section 354, it does say that council can set different tax rates for different classes, but there's still some restrictions on that. So, for example, there's the maximum tax ratio. So your non-res rate can't be more than 5 times higher than the lowest residential rate. And then there's some restrictions on the small business tax rates. It has to be within 75% of the other non-residential subclass, things like that. This also shows a single minimum tax. Your municipalities might have a minimum tax. The legislation says you can only have a single one. But yeah, some places put that in place for budget purposes. Section 357.1 also says that residential tax rates must be set above 0. And that's because that it needs to factor in for the maximum tax ratio. So you can't, it's impossible to divide anything by 0. So that's why it has to be above 0. So yeah, if you want more information, I have a link to that tax rate bylaw webinar a little later. And there's also a case study and things like that on our website. And we will be doing, by we, I mean somebody, will be doing a tax rate bylaw webinar here coming up between between mid-April and May 1st, I believe, is the next round of our Maddie presentations. All right. So on top of municipal tax rates applied to municipal assessment, municipalities also have to collect requisitions to fund certain provincial and regional programs. Each municipality's share of these costs is calculated, like I had mentioned in the beginning, using equalized assessment. So a requisition is permitted on the tax rate bylaw only if there is a legislative provision authorizing it. And these are the only 3 requisitions recognized in Section 326 of the MGA. And of course, it's the Alberta School Foundation Fund, also the seniors housing one, and then the DIP requisition rates. And that last one is, the rates are set annually by our ministry. And, that requisition covers the cost of the province administering the DIP assessment. So the amount required from each municipality for the police funding program cannot be treated as a requisition currently because there is no legislative mechanism to treat it that way. So it has to be part of the municipal budget and funded by the municipal tax rate. If council wants taxpayers to know how much of their tax bill is going toward the cost of policing, there's a couple of things they could do. For example, you could send out an informational brochure that with the tax notices that shows the breakdown of how much of their tax dollars goes where. Could also put that information on the municipal website because I know that's kind of a hot topic for police costs. And with respect to requisitions under Section 359 sub 2, municipalities have the ability to establish a rate to recover what they believe will be uncollectible. This is to help the municipality meet their requirements to pay the full amount of the requisitions, even when they don't necessarily collect all of it from taxpayers. So that rate can't exceed the actual rate of non-collection in the previous year. Also more of an audit function, but each year your auditor will identify if you have an over/under levy with respect to any of the requisitions, and then provide the appropriate increase or decrease that will have to be adjusted for on the next year's bylaw. So that over/under levy comes from the 305 changes that the assessor makes to individual assessments throughout the year. There's no requirement to show that amount on the bylaw, so it can be included as a budget item. So again, we have a very thorough case study on our website to help people understand where the numbers go in the tax bylaw. And like I said, there is still a recorded webinar on that training page that goes through the case study step by step. And keep an eye out for the spring version of the Maddie training initiative planned for the second half of April. You should be getting some information on those offerings soon. I believe if you click on the slide, those links will take you to where you want to go, which is kind of a neat function in Teams. All right, so let's talk a little bit about the tax roll, what must be included on that. So there is a requirement under 327 to prepare an annual tax roll. Mostly this report is kept on hand for reference, but unlike the assessment roll, it is not available for inspection. The tax roll must show all of these items you see on your screen, and it may be a continuation of the assessment roll. So it's pretty straightforward what it would include. If you have a combined notice, I believe the assessment appeal date has to be addressed on the tax roll. Again, there's those new brownfield and other tax incentives that would increase the information you have to. If your municipality uses either any of those incentives, that has to show up on the tax roll. And just to mention that Section 328 provides that taxpayers must provide on request of the municipality any information necessary for the municipality to prepare its tax roll. Also have a list of what must be shown on the tax notice. And although most places will send out these notices well before December 31st, that's the last legislated day they can be sent according to Section 335. And if you send out combined notices, you would have your assessment complaint date, which is the 60 days time period. Going to want to include your penalty dates, things like that. Okay, so someone had asked about the tax agreements. Yeah, that we do talk about that in tomorrow's session. If people are in arrears, the municipality may want to enter into an agreement with them to spread that out over a number of years. Anything else on this slide that requires some more discussion? Maybe we'll take a quick look at the Q&A here. See if there's anything to. All right, so there's a good question about how do you determine the balance between residential and non-res tax burden? So yeah, that's a policy decision, and I know you quite often see them in the news, especially Calgary, that people are always like the business community lobbying the council to readjust that balance between res and non-res. It's a good question. Thanks for that. I think that's the only other question in the Q&A. All right, so let's talk about collection. So first off, there are some non-legislated options that municipality can utilize to make sure people pay their taxes, notifications at certain stages of the taxation process. So the act basically is silent on some of these things. So we take the silence as a municipality's right to exercise its autonomy. And with that, you're able to develop internal procedures and processes for when you will notify ratepayers of their obligation to pay taxes. So there are obviously extra costs if you implement additional measures to communicate with folks. So it's important to determine the effectiveness of the additional reminders and the associated costs. And like I had mentioned earlier, with section 608.1, municipalities can pass a bylaw to establish a process for sending documents, forms, notices electronically under Part 9, 10, and 11. And while that can be labor intensive in its development and implementation, once it's in place, it really can reduce or even eliminate those mailing and printing costs. So what are some ways and when would you send reminders, like over and above or in addition to what's legislatively required? So you could perhaps send emails or text messages to folks that have signed up for those kinds of things. You probably want to place reminders on your website or your social media channels, maybe with your utility bills and newsletters, or you could set up a system to send good old-fashioned letters to people to make sure they're aware of what's going on with their taxes. So the times you might want to do these things is when taxes are coming due, or when a current penalty will be applied, or an arrears penalty. And probably the biggest one before tax file notification, which it has to be done prior to March 31st. So folks that send out letters, you're probably getting ready to do that, or maybe have just done that, to get those letters out to tell them, hey, there's outstanding arrears. You might want to come in to the office and get those cleared up before we register property notification, tax file notification on your certificate of title. And I will talk a little bit more about that tomorrow. So yeah, again, there's some options here with making sure people are aware of where they're at with their taxes, that you can set up your own processes for. All right, so looking at some legislative options as well. And I had kind of alluded to, no, I'm getting ahead of myself. I haven't alluded to tax payment incentives. That's something different than the other incentives later on. But tax payment incentives are covered in Section 339 of the Act, and that's been available since the MGA was overhauled in 1994. So by incentives, I mean maybe you offer a certain percentage discount on people's taxes if they pay before a certain date. And these incentives must be formalized through a bylaw. So the other side of this is to keep in mind, of course, that the municipality needs to create a budget item for this to cover the cost of the discount. So what we mean is the discount you offer, while it's an incentive for people to pay quickly, it's also an expense in the budget. So you'll need to kind of make a guesstimate of how many people will take advantage of it and then budget for that amount as an expense. So it's kind of a mind trick. People think they're getting a discount, but it's actually built into the tax levy through the budget approval. And that expense gets redistributed to everybody through the tax rate bylaw under the municipal tax rate. Hopefully that makes sense. So let's say you estimate a 1% discount on $1 million. That will be incentivized in this way. So that would be a $10,000 expense in your budget, which would ultimately increase how many tax dollars you need to collect to cover that. So maybe you can put in the chat if you offer incentives like that, or if there's something different you offer, so other people are aware of what's possible. The second item I have here is tax installment payment plan, or the TIP, and Section 340 offers the municipalities ability to enter into an agreement with taxpayers to pay their taxes in monthly installments. So this is done by a pre-authorized withdrawal of funds from the taxpayer's bank account. So it eliminates the risk of property owners forgetting to pay their entire tax bill by a certain date. So this type of program must be set out by a bylaw and involves owners entering into agreements with the council to authorize this payment. And however, council can delegate their signing authority for certain agreements to admin person through the signing authority policy or bylaw. Section 340 also requires that tax notices sent out to the owners that opted into the program show the amount and due dates of the installments to be paid in the remainder of the year. So you may not be able to put the whole schedule on the notice, but it should include something like payment withdrawn on the first of every month for the next 12 months is this amount. A separate notice outlining the payment schedule could also be enclosed with the tax notices. Notices also need to state what happens if an installment is not paid. So if someone's bank account did not have sufficient funds to pay the monthly installment, for example, the bylaw could say a penalty is applied per the tax penalty bylaw. So you could put the consequences for missing a payment on the back of the notice, timeline for making up the payment, NSF fee charge, or etc. Most municipalities offering TIP will set out eligibility criteria, such as taxpayers having their previous year's taxes paid in full before being allowed to sign on. And some may charge additional fees if someone wants to sign on midway through a tax year. There's also, just going to mention the compulsory tax installments for mobile home owners, DMH owners. That is there if municipalities want to use it, if they're having issues with collection. But from what I hear, it's a little bit more challenging than just to say people are automatically supposed to pay every month. It's a little bit, there's a little bit of challenge to that. And that would require a bylaw as well for those compulsory installment payments for DMHs. I'm not sure how widely used that is out there, but it is an option. And another option with mobile home parks, I think I mentioned it a bit earlier, is the ability for the municipality to pass a bylaw under 304 to make the park owner the assessed person, and therefore the person liable to pay the taxes for each DMH. So depending on the dynamic of your community, this could be a very controversial subject, but it may benefit the municipality by making the challenging tax collection more reliable. And probably the most common form of encouragement for people to pay their tax bills is, of course, penalties. So sections 344 to 346 authorize a municipality through bylaw to impose penalties on current and arrears taxes. So we would strongly recommend that this bylaw be reviewed to ensure compliance with your tax notice and also for effectiveness. I know some places put the penalty clauses right in the tax rate bylaw instead of having a separate one. I guess it's fine as long as it's by bylaw. I think it's more transparent to have a separate one, to be honest, in my opinion, but it's okay to do it either way. So the MGA restricts penalties slightly by saying penalties cannot be imposed until 30 days after the notice is sent. However, there is no maximum penalty amount set by the MGA. The only legislation we've been able to find on maximum interest or penalty amounts is in the criminal code, and that's maybe the crux of it. There's a difference. I think there's a difference between interest and penalty in the semantics, I guess, but I'm not sure if that criminal code even covers it, but just an interesting thing to be aware of. I believe it's something like 69% or something like that, but I think that might have gone down recently. And once the penalties are imposed, they too become part of the tax and impact current and arrears taxes. So it's important to make sure that your tax penalty bylaw is consistent with your practice of aging the penalties. And I have a slide on that just to show an example in a second. And we also get lots of questions about when electronic payments have to be received by the municipality or processed by the bank to avoid the imposition of a penalty, as the MGA only currently deems a payment to be received based on the date stamped on the postmark on the envelope when people mail in their payments. So For this question, it's important to remember that it's the responsibility of the ratepayer to pay their taxes on time, similar to any other utility or credit card payment they have to make. So I know when I pay my bills through the banking app, it tells me the cutoff time for payments to be processed that day. So it shouldn't really be a surprise for people to make a payment a few days earlier than the due date. There might be something a municipality wants to clarify to make sure people are aware that the payments should be made early enough to be processed in time before the actual due date. And I know the June 30th due date always seems to be a challenge, or the July 1st, since July 1st is a holiday. We always seem to get questions on that. So it's a little bit more challenging to have your taxes due on a holiday, but I guess that something to consider, I guess, when council sets up their due date. All right, I also mentioned the brownfield tax incentives under 364.1. Those are a little bit newer, coming into force in 2018. And brownfields are property that have been abandoned, vacant, derelict, or unused because of actual or perceived contamination. So what the MGA does is allows multi-year tax incentives as a means of encouraging the cleanup and redevelopment of brownfields. So councils are permitted to pass bylaws encouraging remediation and redevelopment of these properties through full or partial tax exemptions or tax collection deferrals. Because previous to the introduction of these sections, the MGA limited cancellations, reductions, and deferrals to 1 year under Section 347. And the problem with that is that it didn't provide much predictability for developers. They weren't guaranteed the same incentives every year, so they might not be as willing to invest in properties that might take multiple years to remediate and redevelop. So this new tax incentive provides the municipality's authority to grant incentives that last the length of the redevelopment process, thereby attracting investment in these less than desirable areas ridden with very significant risk. So we've seen a few of those, few municipalities, or maybe many, I'm not sure. I know I'm aware of a few places that have put that incentive in place for brownfields if they want people to come in and clean up those properties. They also added more recently in 2019, they added the same type of incentive for non-residential incentives, like on top of brownfields. So again, that's trying to attract more non-residential investment by deferring and canceling taxes for non-residential and machinery and equipment assessment classes, which is class 2 and class 4. So municipalities can decide on for how long, and to whom the tax incentives would be offered. So there's they can have an application process. They can target certain industries, neighborhoods, or areas, and they can extend those incentives to a maximum of 15 years with the possibility of extension for up to an additional 15 years. So these incentives, the basis of it is for the general benefit of the municipality. Council has to consider what's best for the municipality when they offer these types of things. And then finally is the recent addition to provide residential property tax incentives for up to 15 years and extendable for up to an additional 15 years. This includes property tax exemptions and deferrals that can be used to encourage the development of affordable housing or other types of residential properties. So these multi-year tax incentives do not require reapproval through an annual municipal bylaw, eliminating the uncertainty that can hamper long-term investment decisions. All right, so that covers the legislative options. I just had a couple of slides. This is what we sometimes talk about with municipalities, if they are using a tip program, to make sure that any rounding errors are covered so that there is nothing carried forward into the next year. This is just an example to show, like the last installment has to be brought up by an extra few cents to bring it to zero balance. Because you have your 2025 tax is still being levied in the first half of 2026, and then council passes another bylaw partway through the year, and then the second half of the year is a different rate. So this is just to show that calculation. I'm not sure if that's an issue for folks out there, but I just wanted to bring that to your attention. If you have any more questions about this, we can certainly discuss this in more detail. Because when you're dividing something by 12, there's likely going to be a rounding error that you have to address so that people don't get into arrears. But again, I did notice the tax notice needs to fully disclose the payment plan, so there's no surprises to the ratepayer. This is just another example of how to do that calculation if you're interested. And the other item I wanted to just lay out here, I know there's lots of numbers on here, but it's when I had mentioned the penalty piece. Section 346 says a penalty imposed under 344 or 345 is part of the tax in respect of which it is imposed. So there can be a couple of different interpretations here of Section 346. And this is really only relevant for property taxes in arrears. So it might sometimes requires a conversation with your auditor on how it should be calculated and shown. So on the left side is a system that cannot age a penalty back to the years in which it's associated with. And on the right-hand side is a system that can. So it just shows the different calculations. So you have year one, year two, and year two, the amounts are, the penalties are aged back to those years. So it's important in my mind as how a penalty invoice is aged impacts the number of years in arrears a property is in. So it could be the difference in registering file notification. And I talk a little bit probably more about this tomorrow as well. So yeah, it depends on the software that you're using. Some has the ability to age the penalties and some doesn't. So just wanted to draw your attention to that. Okay, and this is just a little bit of a summary on the 4 main assessment classes. So class 3 is farmland, can't be subclassed. This is class 1, the residential. It can be subclassed. Then we have machinery and equipment, class 4. Cannot be subclassed. And then non-residential can be subclassed. And then just to test your understanding, there's a few questions for you here. On what date are property values determined for a specific year? Answer is July 1st. Which of the following is not one of the 4 main property classes for assessment purposes? would be D. The formula used to calculate property tax rate is C. Legislated deadline for an assessment roll to be prepared is February 28th. And how many days do people have to file an assessment complaint after the notice of assessment date? Is 60 days. All right. I think we'll maybe take a few minutes to look at the questions if my helpers want to talk about anything to highlight in the questions. I haven't had a chance to look at. There were a few questions about aging. So again, yeah, it's section 346 talks about the tax, the penalty becomes part of the tax in the year at which it was imposed. So if there was taxes still from 2024, your software might be able to age back to 2024, what is applied in 2026. Any other questions that you guys think you want to draw attention to? Are there any additional questions folks have on anything I talked about here? Maybe that's a good sign.
There's one that just came in here about what section was the tax incentive portion documented in the MGA.
You mean like the 1% for paying your taxes early? 339, is that's the one? Questions in the Q&A. Okay, yeah.
Yeah, it's 339.
Any other questions here in the chat or in the Q&A that haven't been answered? So I do have our resources listed on this slide. Again, you should be able to click on the links and they should take you to those resources. I have the schedule for the assessment timelines, assessment dates, which is handy to have. And I hope you have a good rest of your day. Oh, I see a question. Okay, the question, are there any requirements to have the same address on the tax roll as it appears with land titles? Sometimes you can have an additional, you have to at least have what the land titles show. The land title shows for an address. But yeah,
I mean,
go ahead.
That's all you have to go off of, right? Is what is on there, but there is a section under the assessed person, 303, right? So as a municipality, you are required to use that legislative mechanism of the land title to send your notices and your notifications to. But under section 304, my apologies. There's a section. 304.3. A person who purchases property or in any other manner becomes liable to be shown on the assessment roll as an assessed person must provide to the municipality, in the case of the property, written notice of a mailing address to which notices under this part or part 10 may be sent. So land titles is pretty quick these days, I think, when we get into huge real estate crunches, sometimes they can fall behind, but usually they're pretty quick about that. Getting the changes out to municipalities. But there is always going to be a time lag around when you send your assessment notices out versus when you send your tax notices out, whether you have absolute current information on who you're going to send your notices to. So if you have somebody who sends a letter in and says, hey, my address has changed, I haven't had a chance to update land titles yet, or they don't want to pay the $25 to update land titles, whatever the case may be, I would add that new address and send it to both. That's what I would do. But that's just kind of my 2 bits on it. And if they don't know that they need to update land titles, that'd be your cue to let them know as well.
Yeah, I get that there's folks that are resistant to changing their information with land titles for whatever reason. But yeah, like Des says, to use what's on there plus whatever they provide, like send it to both is what we usually say. So thanks, Des, for that. Thanks for that question. That kind of spurred some spurred some other folks here. Sounds like it is a bit of a issue.
Yeah, I don't, do you think it's the fault of land titles that the address is incorrect? I see, Janelle, you've added a comment there. I think it's people who are not updating their addresses, and that, land titles can't, that would be difficult to police, so.
So this, Asha says they're behind. It's up to December 18th, 2025. So a couple months behind. And land titles is not very quick.
Oh, that is behind. Yeah, well.
There was another question here from Maureen about sending electronic notices, and both husband and wife are listed on the title. Do you have to have permission from both of them to send an electronic notice? If you can't get permission for both, would you still need to mail a copy to the other person?
I mean, if one person's not giving you consent, is it because they are actually not maybe living together, right? And so you might not necessarily know that. So I think you would have to send one notice electronically and one by paper, unfortunately.
I think that would be erring on the side of caution for sure. That's probably the better way to go with it, at least the best practice.
All right, anything else? There's something in the Q&A as well, I see. Oh, okay, that's the 339 question. Anything else in the chat? If they wanted electronic, do we have to send paper copy as well? I thought there was something you had to be able to print off copies in order to do electronic. But if you're, from my understanding, if you're doing electronic, you don't send it. You don't have to send a paper or hard copy. Right, yeah, if you have a bylaw in place, then electronic is what you use. But I imagine people come in and say, well, I lost my, can you just print me off a copy? I deleted it from my whatever. So I think that's what you would have to do, print it off for them. All right, thanks so much, everyone. Have a great evening.